Good morning, everyone, and welcome to ezyCollect webinar today. I'm Nana, Head of Finance and Business Insights. Today, we'll continue our Cash Risk and Return series, Part 2, the AR metrics that keep managers in control. And here with us today, our regular guest speaker, Nick Cooper, our CFO.
Hey everyone, thank you, Nana. Look, it's great to be back. Obviously, I joined as a special guest for the last. Obviously, did an all right job to be invited again for part 2. So that's very nice. Thank you for the honour, Miss. Look, I promise you this won't be just your typical AR numbers chat. We do hope to download to you the kind of typical metrics that we like, part 2, that we track, we monitor, and hopefully ezyCollect can help you understand better to keep you collecting faster and keep your CFOs happier. So that's the aim. That's the target for today in sort of 25 to 30 minutes if we can get it done.
Absolutely. In 30 minutes, we'll review the 5 operational AR metrics that you can use for your cash flow engine. And before we dive in, let's take a quick quiz to understand our pain points.
Love a quiz.
All right. Which is the biggest challenge in your day-to-day AR operations? A, customers consistently paying late. B, high volume of disputes or slow dispute resolution. C, lack of visibility or real-time reports. D, balancing credit risk with sales pressure. Or E, chasing too many invoices with too little time. Let's see. Okay.
Have a look, people entering away. It's what do you think for us? As well, people are filling out their piece. What do you find that is the toughest for you in our team?
Hey, I would say is to me it's all about how to keep our team on top of all the metrics in the best, most efficient way. Like, because there's so many different areas that we need to look into. So probably to me, it's not must see lack of visibility or real-time reporting. And this is absolutely something that we are striving for improvement over the next few months, I'll say. Yeah.
Of the results that have come through, we've got most people saying customers just consistently paying late, which is painful. I mean, it's the one thing that obviously ezyCollect's there to really target and focus on, but it's out of just from execute on a BAU collection process. It's very much out of control. So it's a lot of things in place aimed at trying to take that back into control. Yeah, very interesting. Very interesting. Okay, cool. All right, thanks, guys.
Let's kick off with the post-check metrics, AR to sales ratio. It shows how much of your revenue is stuck in unpaid invoices, and you can see how hard your cash is actually working out.
Yeah, that's right. So the ratio, look, it's a pretty straightforward ratio, and we're all fairly probably comfortable with mathematics. But it's about how much of your accounts receivable after that collections period is still left in that limbo, i.e., it hasn't been collected. So we talk through a really easy example. Let's say you've had $500,000 of sales in the period. At the end of that collection cycle, you've got 100,000 outstanding. Your ratio then would be 20%, right? So look, simple. But actually, where there is useful and benefit in that is understanding how you sit in relation to your, let's say, industry, whether that be, if you're in, let's say, the whole manufacturing construction industry, like we see those metrics sit anywhere between 20 to 40% in terms of that ratio. Wholesale and distribution, on our B2B side, we kind of see that improve a little bit down to 15 to 30, and retail, I mean, there's not massive amounts, but that's down to about 10 to 15, which is obviously where you want to try. Anyone will want to try and be. You want that ratio, I guess, as low as possible. But it's knowing where you are within your peers is actually really helpful, because sometimes there's industry norms, ways of working which are really hard to kind of break out of, and so you therefore have to be kind of, you want to benchmark yourself to see where you sit and operate with your peers, most importantly. But obviously, where you want to be is as low as possible. That goes without saying.
Absolutely. So if your business should be in the 10 to 15-ish zone, but you're actually at 30%, it's a serious cash flow leak, isn't it?
Yeah, look, and you know, it's what you want to do is, as I was mentioning, getting that down as low as possible. And if it is high, you know,
Mm,
what's driving it? Well, the obvious answer is slow paying customers. But if you look behind why are they slow in paying? Is it because you've got weak credit policies and you're just not enforcing those? So, you know, a lot of our B2B partners sell on, you know, 30-day terms, 60-day terms, etc. And is it you're not enforcing those, you're not following those up, and they're kind of starting to slip. If they're paying late, even with that, is there kind of like a relationship issue that you need to get behind and investigate?
mm,
Within our credit insight module, it's, you know, we are able to, you know, with, I guess we've got this kind of fairly large data lake of, let's say, trade interactions, and we can be telling partners, you know, hey, you're getting paid later than everyone else we see on our platform from this
mm.
particular client. Maybe go and investigate that. So, you know, when people pay late, it's off, you know, it's, a lot of the time it can be some financial reasons, but it can also be relationship based reasons. So there's really something there to kind of, yeah, uncover if you can. Other
Absolutely.
reasons why those things go out, though, Nano, you've got, you know, you might have what is your process? You know, have you done an end-to-end process mapping of your collections piece? And is there any improvements? You know, it's all about the 1%. What can you do to kind of automate some of those activities, to kind of smooth those out, and make sure that there's no kind of roadblocks to kind of ensure that that's slowing that down. We see like increasing percentages of disputes and deductions, kind of really slowing down those collections and pushing those AR to sales ratios out.
Mm.
And, you know, more and more, I think, in sort of some tougher economic times as well, there's
Yeah.
people maybe rely a little bit too much on giving extended payment terms just to get deals done, and so actually really kind of understanding, can you pull some of those back in and you know, bring those back into what you're happy and comfortable with, is what we obviously want to do. And look, what we'd say is that these things, like, don't fret. Are a lot of really simple, straightforward things that people can do and lean on in order to kind of improve this metric. I'd say a lot of them are obvious, they are, but actually there's still a whole bunch of people who aren't employing these things to improve it. You know, automated reminders and flow ups. I think that's like a baseline. People have to be doing that. It doesn't always
Mm.
happen, but having those things set up and ready to go in their systems, you know, having digital, one that we really feel is a game changer is having digital payments, but and collecting authorities up front, so that as those things fall due, you've
Mm.
already got that delegated authority from your customer
Mm.
to collect those funds. You know, we see our partners who have DDAs and digital payments employed, their AR to sales is incredible. So like having those things ready and in use is really good. You know, you can benefit also by the use of having payment plans, improving your credit checks up front so that you're only onboarding good you know, well-paying customers and clients. You know, obviously helps. And then if you have you know, some dispute resolution process as part of your kind of invoicing, you know, you can really then take control of disputes, because we see those blow out, and then, you know, that's where people then the AR to sales ratio also suffers at the same time. So having a well let's say worked out and worked through process for that is important.
Absolutely. I totally agree with you. Um, in addition to all the methods that you mentioned above previously, the one thing actually very exciting that already sort of on our roadmap, that is payment policies, which basically
Love
incentivize.
payment policies.
That's
Yeah.
that's right. Early payment would receive some discount, whereas the late payments would have to pay penalties, and that is what coming up. Our team at ezyCollect are working very hard to deliver that feature in the coming.
Nice little forward sell. Yeah, like right now. And you know, and Nana's being modest there. She's being so really instrumental in helping guide some of that usage, because you know we are the finance team of ezyCollect, so we are intimately doing the same day-to-day activities that the accounts receivable teams, AR credit controllers, etc., are doing in your businesses. So yeah, we have a lot of input to these, and she's being really instrumental in this. And I'm super excited about that as a product. We've been requested. That's we're bundling a whole bunch of items into this payment policies product, but it's been requested for a long time now, and actually we do think this one is also going to be a game changer. So it's that ability to reward good paying customers with potentially discounts or extended terms, maybe if they are regularly paying on time, but also then the ability to perhaps penalize those who are paying consistently late, should you choose to do
Absolutely.
that. Yeah, it's cool.
Now let's talk about the AR aging report, the navigation of collection.
Yeah,
What's
classic.
your take on it?
Yeah, I mean, look, it is a classic one. This one, there's nothing new here. We should all be across this. We should be doing this day in, day out. But it's still a really important one to have. It's funny how people don't analyze it, I think, correctly. We use it very
I
much
would
that.
say people analyze it too late, like either at the end of the year or every 6 months, most of the time. Yeah, I would say I would try to look at it and be on top of it every fortnight, at least with the building team. What do you think?
Yeah, look, I think analyzing it, but then also having really clear actions around what you're
True. Yeah.
doing with each things in each bucket. So, having the ability to dynamically risk-based follow up certain clients in certain buckets, having preemptive reminders, if someone ticks over into a certain, bucket, let's say once they tip over into 60 to 90 days, there's an automatic reminder statement sent out. That's important. So having really clear actions for your AR team for
Yes.
when things are in certain buckets, when clients are in certain buckets, really helps stop it from, let's say, escalating into that. Like, no one wants to be in that 90 plus days. You don't want anything sitting in there. That's when your chance of collection are getting lower and lower, and that's when you may then start to say, all right, well, we need to employ a debt collection partner to do that. Look, I'd also strongly suggest people have a good relationship with a debt collection partner. It sounds bad and ominous to send something to a debt collection, but actually it gets it off your plate. It means that you are then able to focus on the business, and actually if it's done early enough, it can be quite a low touch activity with minimal kind of fuss. We've got the guys from the Australian Collections Group who are really sound partners of ours, along with Armour in previous years, and so I would always encourage people to have just that at the ready, certainly if something hits into that kind of 90 days plus bucket. But I think knowing your customers, segmenting your customers, and having really clear call to actions around what needs to happen when they're in there is important. So, collect now, it's a feature we've got within the payments module. You can kind of go and collect whenever something flips into a certain bucket, if you've got those direct debit authorities in play, and just escalation within your own hierarchy around, if something should fall in. All right, so if it's 69 days, all right, now Nick needs to call. The AR team has not had any luck. We need to get the Nana or Nick following that up, because we're not getting any headway. That's letting things don't let things drag. So that's important.
Absolutely. And I would say the next one, maybe we just go through the industry
What we
number.
typically see, yeah. Look,
Yeah.
again, if we use the same, look at similar ones that we had from before. So the wholesale sector, there's a whole bunch of these guys sitting in the 30 to 60 days. It kind of comes back to the fact that they use net 30, net 60 days, often agreed up front for things to be paid after delivery. It's not unusual, and it's fully where I would expect them to be sort of sitting as a sector. Construction, typically falls a bit later. I mean, this
Mhm.
is 40 to 60 after paid, and obviously they have longer lead times anyway because of the nature of that industry. But we see these things kind of going out even longer because of like milestones. A lot of them have gates that they need to be met. There's
Mhm.
approvals and limitations within the kind of the frameworks of those agreements and the construction that happens that means that they actually typically fall out even a bit later. But then the good old retail sector, it's all a lot of it's there's still cash on delivery. They're down to 0 to 15. They're in a really great spot. But that's just the nature of those businesses. And so again, I would go back to knowing where you sit within your peers is probably
Mhm.
more important than like trying to benchmark yourself against everyone in the space.
Awesome. Now let's go to the next metric, the average days delinquent, ADD. ADD may not have the popularity of its cousin, I would say, DSO, but it's also a great metric that will tell you the real number of days your customer pay you late beyond what your terms set out. Right? For example, if an invoice has 10-day term, but the payment lands at day 29th, you have got an ADD of 19 days late. What do you think about these metrics in particular, Nick?
Look, it's an easy one. I mean, again, none of the ones we're telling you guys here today are like super complex formulas. It's actually really easy and straightforward things, but it's about knowing them, about being able to track and follow them, which is what's important, right? And this one, ADD, I think, like you said, it's an early one to be able to kind of, it's quite a good lead indicator of like things are starting to go a little bit pear shaped here. We're starting to like the days late of our pays are starting to blow out a bit. Like what's happening and what's behind that. So look, if we've got some analysis there on the different sectors, and so again, manufacturing and construction is not ideal. It's not a great. If you're in those sectors, it's a tough one. They're at sort of 30 to 60. Retail and SaaS, again, great place to be, 10 to 15. But where we saw in our analysis of our ones is that health and education, bit of a blowout, 40 to 90.
Yeah.
I'm not sure if that's typically because maybe there's government-backed activities, so people are kind of like, well, I can kind of pay those things a little bit late because they're either backed by governments or public schemes. So it's the exact cause and nature of some of these is probably warrants a little bit more investigation. But from what we had seen, yeah, it's health education was surprisingly large.
Oh, yes. I was surprised at that metric numbers as well. And to me, ADD is the first metric that would spike when something goes wrong, both at macro and micro level. So it reacts very quickly to changes in the environment, like the slowing economy or customer tightening their cash positions or like any changes in payment disciplines. Right. So given the macro headwinds in 2025, I would say that many companies are more vulnerable to cash flow stress and rising ADD. Therefore, tracking these particular metrics is actually something that we should pay attention to. Now, let's talk disputes, a very interesting topic. They show up unexpectedly and turn everything upside down.
Yeah. Look, it's like disputes is a tough one, and we sort of did mention this up at the top of the session
Hmm.
when we were talking about the AR to sales ratio. Tracking the disputes and I guess the resolution time of those is important because, as you said, Nana, like they show up when you're least expecting them.
Yeah.
They kind of just appear out of nowhere. A lot of the time, the process for these is not well defined within the business, and so
Mhm.
actually what it does is just elongate the payment of that invoice. A lot of the time, we see that this actually isn't a problem with the customer. It's actually a process problem. So where we see issues, and look, we see this in our own, like our payments module. If disputes come back through via us, we help our partners kind of get those resolved, and a lot of them kind of tend to kind of come back to like the invoices missing purchase PO numbers, like wrong quantities being entered onto invoices, missing delivery notes, unclear descriptions. Like all of these things like go into the melting pot to kind of really mean that the client who, when they're paying, is like, that's not what I'm about. I'm gonna dispute this. Worst case though is when they dispute, but they don't actually even tell you about it. They just don't pay.
Oh, that's the worst.
Um,
No,
and more,
the worst is actually they did not dispute with you. They dispute with the bank, and then you only got to know it after you received the notice from the PO.
that is even worse. So yeah, I mean, look, it's one of those things that you need a good process in place. I think on the next slide we've got a few little interesting stats, and I won't go like through like each one like in turn, but it's really telling that if you don't have a good process in place, this can like be one of the ones that really kind of blows out. Like the AR to sales ratio that we saw before, but you should be individually tracking these as well at the same time. So it's it's an important one.
Oh, sorry. Sorry, just one second, Nick. Manji, can you please double check? Because Lucas said that people can only see ADD slide.
Oh, it's not progressing onto the next one.
Yeah. I can see the dispute slide on my end, but can someone please respond to the chat if you see the resolution and dispute slide? Okay. Oh, good.
Okay, sure. And so I just saw Alison's
Thank
comment.
you.
Hopefully my audio has improved a bit, Alison. Sorry if it's still bad.
Okay. Good. Now, sorry for that. Yes, absolutely, Nick. I think disputes is just horrible when disputes everything drags down with them. Basically, collectors waste time chasing the incorrect invoices. Customers lose trust and cash obviously gets stuck. So, what's the solution for this?
Look, there's a few things. I mean, like I said, having your own clear process. We have been playing around with some things here internally around that. I guess we're trying to gauge the level of interest in having something around dispute management within ezyCollect today. There we go. Little leaked screenshot. Very much prototype. Very much something that we're trying to gauge the interest. There's a significant amount of work to get it in, but what we've done is being able to show that actually we believe it's effective to have it within ezyCollect, because what it does is it centralizes where these kind of activities can be tracked and monitored and managed. But if clients are paying within a portal, like the payment portal, that's their interaction with you to ezyCollect. If I just talk really quickly through those two screens, what you're seeing there, the one on the left is how you would potentially manage this within the ezyCollect dashboard from our client side. You'd see what's being raised as disputes. The screenshot on the right hand side is your customer's side. So when they're coming in, you'll recognize behind that kind of like main screen that's in the center, you can see obviously the common, you guys will be used to the kind of standard payments portal dashboard. Select the invoices you want to pay. What they'll be able to do is kind of go in, select an invoice or multiple invoices that they want to dispute, or at least question, make a comment, and then basically it opens in a two-way conversation via ezyCollect to be able to discuss, why they want to short pay, or at least make a note why they're short paying or why they're not paying it at this instance, and why they want to have a discussion around that. So yeah, look, we'd love to gauge the interest of everyone out there around whether this should be come out of more than just being a sort of a high level prototype and a working piece, and if it'd be useful. But we see, like we say, we see this metric as being something that really needs to be tracked and monitored, even outside of ezyCollect. You guys can do it on your own. because it does, this is where we see like unexpected, elongation of the cash collection cycle. You only need one big payer to sort of start holding up in here because of late or spoiled goods or whatever it may be it's causing them to not pay
Yeah.
in full or not pay at all. So yeah, it's an important one.
Awesome. So we're running out of time, so I'm going to quickly go through the last metric, cost of AR. And would you like to give us a little bit of insight about this cost of AR, Nick?
Yeah, so look, if you think about all the things that go into the basket of if something doesn't get paid. So, if you don't collect your cash on time, what's the cost of capital potentially that you need to, let's say you need to take out a small working capital loan, what's the return of something that you could have gotten if you had that cash on time? So what's the cost of that capital? The direct cost of funding, like I was saying before, so overdrafts, working cap, bank loans, etc. The cost of money, if it's a really long, elongated period, you could take into account the inflation costs, opportunity cost, and the risk cost of these things. And if you kind of come up with a result for that, we're looking at a number, a variable number here. It really kind of impacts you. So if we take the example of you've got let's say you've got 100 grand outstanding, and let's say your cost of carry is 12%. I mean, it's a pretty high number, but this is more for the ease of the calculation. 12% annually, and your invoices are unpaid for 30 days. That's about $1,000 lost in a single month. And so it's a really important one for you guys to understand. Like, it's basically trying to put into monetary terms what you're losing out on. Should your when you're carrying accounts receivable through into the next period. So if we look at across the industries, we're using the sort of the same ones we've carried through from the last one, but obviously manufacturing, construction, cost of carry is about 5 to 10%. Wholesale at 3 to 6, and retail 1 to 3.
Yeah.
So it's way we've calculated those is because of the extended periods. A lot of that's like the amount of time those things are being carried through, the cost and the risks around carrying it. And it's just another one of the interesting point for you guys to kind of look and analyze as you go into your AR metrics moving forward.
Absolutely. And it's interesting how like everyone talking about the drawbacks, the disadvantages of long AR, but no one, well, very, very rare that people actually quantify the amount lost due to prolonged outstanding invoices. So before we wrap up, I would love to do a mini survey. If you can, please quickly answer. If you could improve just one thing in your AR process today, what would it be? A, better credit assessment and onboarding. B, automated reminders and workflows. C, online payments. D, stronger dispute management. Or E, clearer reporting and analytics.
Amazing.
Oh, wow. Wow, I did not expect the result to be a credit assessment.
Ooh.
Wow.
Like
Yeah.
that.
Like I said, well, I think it's part of the economic downturn that we are experiencing lately that definitely spiked the interest in credit assessment and onboarding. Oh, wow. What's your take on this, Nick?
Yeah, look, I think I'm a big believer in the credit assessment. Upfront onboarding good customers, knowing where they stand is super important. Like, why would you want to take on someone who's a bad payer, hasn't got a great track record? It doesn't make a lot of sense. And so, and in this modern day, where especially if your trade interactions are more digital as opposed to in person, knowing exactly who you're dealing with is super important. So why would you not try and do that as part of your process up front? Like, that's for me is a no-brainer. But there is process. There's a bit of cost up front to kind of make sure that happens. But it one improves your collections, but also it makes sure you're not kind of onboarding potential bad debt in the future.
Yeah, just like our listener just said, in the comment section. If you start off with a good client, then your risk is low from the start and less action required. You save more cost, save more time. Absolutely.
100%. 100%.
Yeah.
Cool.
Now, thank you everyone for joining our webinar. If you want deeper breakdowns and tools to apply the metrics, head to our ezyCollect Academy page full of practices and templates you can use immediately. And thank you for joining us today. Thanks, Nick, for being our guest speaker.
Thank you, Miss Lay. Thank you for the second invitation to return. I was very welcome. So thank you very much for having me.
Thank you, everyone. Have a good
Thanks,
day.
everybody. Cheers,
See
guys.
you.